Welcome to the Riskwiser Zone, the show where we dive into the world of finance and explore the latest developments that impact your investments. We've got a packed show for you, with a focus on the upcoming Federal Reserve meeting and its potential implications for the cryptocurrency market. As we speak, Bitcoin is trading at around $67,171 with a 4.9% gain over the past 24 hours. The broader altcoin market is also seeing some positive movement, with Ethereum rising 10.9% to $1,843.34. But what's driving this surge? According to reports, a potential United States-Iran deal is said to be close to being signed, which could have significant implications for the global economy and, in turn, the crypto market. On Wednesday, the Federal Reserve will present its latest data under new Chair Kevin Warsh, including updated assessments of inflation, growth, and interest rates. The CME FedWatch tool is predicting that interest rates will remain unchanged, with a calculated probability of 98.6%. But what does this mean for Bitcoin and the broader crypto market? If the projections point to fewer rate cuts than markets currently expect, we could see downside pressure on Bitcoin. On the other hand, if the dot plot confirms that additional rate cuts remain possible later this year, this could be seen as a positive signal for the crypto market. We'll also be keeping an eye on U.S. economic data, including the Empire State Manufacturing Index and key housing market data. Stronger than expected retail sales could suggest that the U.S. economy remains robust, giving the Federal Reserve less urgency to move towards rate cuts. But weaker data could strengthen expectations of a more accommodative monetary policy later this year, which would generally support Bitcoin. As we navigate these complex developments, it's essential to consider multiple perspectives and avoid making any rash decisions based on emotions or biases. We'll be taking a closer look at the potential implications of the Fed meeting and the US-Iran deal on the crypto market, and exploring what this means for investors. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of technology and artificial intelligence today with a fascinating story about Microsoft's newest AI agent, Copilot Cowork. This innovative system is designed to handle complex tasks from start to finish, taking entire projects off your plate. With its ability to execute long-running, multi-step workflows on behalf of users, Copilot Cowork has already gained significant traction, being used by over half of the Fortune 500 companies. What's interesting about Copilot Cowork is its flexibility and scalability. It can tap into different AI models depending on the task at hand, and its consumption-based pricing strategy allows organizations to scale their usage based on need, rather than paying for unused capacity. Microsoft claims that this approach makes Copilot Cowork roughly 30% to 40% cheaper per prompt than competing enterprise AI offerings. As we explore the potential of Copilot Cowork, it's essential to consider both the benefits and the risks associated with relying on AI agents in the workplace. On one hand, automating complex tasks can increase productivity and efficiency, freeing up human resources for more strategic and creative work. On the other hand, there are concerns about job displacement, data security, and the potential for biases in AI decision-making. Microsoft's emphasis on enterprise security controls and its WorkIQ context engine is a step in the right direction, but it's crucial to continue monitoring the development and implementation of Copilot Cowork to ensure that these risks are mitigated. As we move forward in this era of rapid technological advancement, it's essential to strike a balance between harnessing the power of AI and protecting the interests of individuals and organizations. Welcome back to the Riskwiser Zone. We've got one final story to wrap up today's show, and it's a big one. As you may have heard, President Donald Trump has announced that the United States and Iran have signed a memorandum of understanding aimed at ending the ongoing conflict between the two nations. This development has sent shockwaves through the global markets, particularly in the energy sector. According to reports, the agreement includes plans to reopen the Strait of Hormuz, a critical waterway that accounts for nearly a fifth of the world's oil and liquefied natural gas supplies. The reopening of this strategic choke point is expected to increase global oil supply, which has been significantly impacted by the conflict. As a result, oil prices have plummeted, with Brent crude futures settling down $4.16 or 4.76% to $83.17 a barrel, and U.S. West Texas Intermediate settling at $80.75, down $4.13 or 4.87%. This sharp decline in oil prices has significant implications for investors, particularly those with exposure to the energy sector. It's worth noting that while this agreement may mark a major breakthrough in relations between the United States and Iran, there are still many uncertainties surrounding its implementation. For example, it's unclear how quickly Middle Eastern producers can resume oil production and exports following damage from the war, and whether more ships will enter the region. Additionally, the fate of Iran's nuclear program remains a contentious issue, with further talks expected to take place in the coming weeks. The international community, including nations such as the UK, France, Germany, and Italy, have expressed willingness to lift sanctions on Iran in response to steps taken on its nuclear program. As investors, it's essential to remain cautious and monitor these developments closely. While the potential for increased global oil supply may lead to lower energy prices, there are still many risks associated with this conflict, including geopolitical tensions, supply chain disruptions, and potential long-term impacts on global trade. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.